Okay, good morning, everybody. This is Lori Hensick, your American Military Partner Association Director of Policy and Research. Um, I just wanted to welcome everybody to the webinar, and thanks for, giving us your time today for those of you who are on the West Coast, like me, this morning, and your afternoon for those of the East Coast. Before we get going on the webinar, I wanted to let you guys know that the webinar will be recorded. I'm recording this session so that if you do, have to pop in and out of the webinar, or if you know anybody who couldn't join us at the scheduled time but is interested in listening to the information at a later time, it's going to be posted probably within about 48 hours after the webinar on our actual website, which is www.militarypartners.org. So we have the pleasure of being joined by Karen Bolender, who is an AMPA member, and she's a CPA as well as a partner in her firm in Michigan. She is a spouse of a retired Air Force veteran and helped us last year with our webinar as well. So for those of you who are joining us for the second time this year, you'll recognize her voice. So just a little bit about what we're going to do in terms of how we format this webinar. Karen will be presenting all of the slides, and I'll be moderating. There is a chat box that you can use for this session. During the webinar, please do feel free to send questions to me in the chat box, and intermittently throughout the webinar, I'll be, interrupting politely Karen and asking her some of your guys' questions. And then for those that don't get answered, sprinkled throughout the webinar, there will be time reserved after the actual presentation to go through a Q&A session. And then lastly, for anybody whose questions, due to time limitations or what have you, were not able to be answered, Karen and I are both available, via email, and we're more than happy to continue to facilitate answering any of your tax questions as best as we are able to via email. So please don't be bashful. Feel free to reach out, and we'll provide both of our email addresses at the end of the webinar. They're intermingled without the presentation slides as well. So without further ado, I'm going to hand it over to Karen.
Good morning and good afternoon for both coasts. So for those of you that were in the webinar last year, the format is going to look exactly the same. I'm going to cover the federal taxes this presentation, and then we'll conquer the state taxes next weekend. So basically what I have to put the disclaimer in there because I don't know everybody's individual situation, so this is just an overview of how federal taxes should be filed based on all of the new and exciting events that have happened in the last year, last 2 years, and hopefully in the future 6 months. So are you already married? That is the big question for federal taxes. And the federal government recognizes any same-sex marriage that was performed in a state or a foreign country where it's legal. And you can reside in a state where there's not legal recognition. The numbers are much smaller than they were last year, but they still exist. I happen to live in one of them. And you're still considered married for federal tax. So the question is, were you married before December 31, I should say on or before December 31 of 2014. If you were, you're considered to be married for the entire year of 2014. If you were married in 2013 and you filed your 2013 tax returns as two single taxpayers, you are required to amend those tax returns and file under one of the categories of married, whether that's married filing jointly or married filing separately. If you were married prior to 2013, there is still time to amend earlier tax returns. We'll talk about that in just a little bit. And for those of you that are in states that have registered domestic partnerships or civil unions, those are not recognized as marriage for filing tax status. So now that we've determined whether or not you're married or single, which form do you use? There's actually 3 different forms for the 1040. There's the 1040EZ, which is the basic of all of the forms, and it works great if you're single or married, filing jointly only with no dependents. And your taxable income is under $100,000, and it comes directly from W-2 wages, unemployment compensation, or interest income. The only federal tax credit that's available on this form is the earned income credit. You cannot itemize, and you cannot use this form if you're filing married filing separately. This is what the tax form looks like. It basically only has a section for your name and your address and your Social Security numbers. There's no area for any dependents. The payments and tax credits, as discussed, earned income tax credit is the only item of tax credits that are available. New this year, there is a health care question, and I'm going to cover that in detail later on in the slideshow, but I wanted to make you aware of it, that there is this question on all 3 forms as to whether or not you've had health care. So the next form would be the 1040A, which is a shorter version of the 1040, and it's available for any status. So you can use this single, married filing jointly, married filing separately. You can have retirement income, interest and dividends, as well as W-2 wages and unemployment. You can take student loan interest, education expenses, so you have the ability to have the adjustments on your tax return as well. You cannot itemize your deductions on this form, and there's a threshold of income. The tax credits are expanded to the ability to take your child in dependent care, because on this form you can have dependents, your education credits, retirement savings, as well as the child tax credit, and then the earned income tax credit. Here's the exemptions where you have the ability to put your dependents. This is from the 1040A. So there's an expanded section. Here it also shows on the income that it's expanded. You have the ability to put in your IRAs, your pensions, as well as Social Security benefits, which are all related to the retirement component. And here's the adjustments to the gross income. So this is where you have the student loan interest as well as your tuition and fees. And you have the IRA deduction that you can take $5,500. If you are older than 50, you can add $1,000 to that and actually take a pre-tax deduction of $6,500 to put into an IRA to take out at a later date. Here is the tax credit. You'll see that there's a lot more of tax credits that are available. Line 38 is the health care individual responsibility, the full coverage question, as well as, let's see, the net premium tax credit, which is related to the health care coverage, and that will be discussed later. So if you're not able to use the 1040EZ or the 1040A, then you'll need to utilize the full-fledged federal form 1040, and this is where itemizing your deductions comes into play. Most people who don't itemize will use a 1040A. So the itemized deductions, the majority of individuals that use a Schedule 1040 with the Schedule A, which is where the itemized deductions are located, is due to the fact that they have home mortgage interest and real estate taxes. They have the personal property taxes on their vehicles as well as boats. They have state withholding. They give charitable contributions, and a slew of other items such as medical and reimbursed employee expenses, and if you pay someone to do your tax return. Again, on the 1040, the income section is expanded. You'll notice that you now have taxable refunds, credits, or offsets of state and local income taxes as an item, alimony received. There's a business income. If you're self-employed, you have a Schedule C income, you would need to use the Form 1040. There's line 17 is rental real estate, royalties, partnerships, S corporations. If you have any kind of investment in a company and you receive a K-1, you would use the 1040. Farm income, as well as the Social Security, pension, and W-2s. So there's an expanded adjustment account, or adjustment section, and this is on account of you have your Schedule C, which you have self-employed tax that you have to pay. Part of that is deductible. You have the self-employed retirement plans that you're able to contribute into prior to getting to your taxable income. You have the self-employed health insurance deduction. You also have alimony paid if you're paying alimony. The IRA deduction is still there. The student loan interest, education-related expenses are there. Moving expenses, if you've moved and you've paid for the moving expenses out of pocket, you can take it as an adjustment to your gross income, thus lowering your taxable income.
Karen, I'm going to interrupt you really quick. Sorry.
Go ahead.
So regarding, and I just want to clarify for those folks who are on the call or who are listening, or on the webinar, who are going to be listening at a later time, just for those who are not familiar with the jargon, like whenever you were to hear somebody say, oh, I'm going to use this as a tax write-off, quote unquote, that's kind of what we refer to as what itemized deductions are. So if you think that you have things that somebody has told you that you can write off of your taxes, that would mean that you would use those as line items if you were to do itemized deductions. That's the formal term. But in terms of moving expenses, there's been several questions with this. Do moving expenses have to be tied to a job move, or can they be any sort of moving, like any reason for the move itself?
So generally speaking, moving expenses are related to a job. If you move greater than 50 miles for a job. There's other guidelines that can be used, such as, you know, if you move, but you don't necessarily move for a job, but you maybe start a business once you get to your new location. If you meet the number of hours that you participate in that business, you can actually take your moving expenses. If you look at the instructions for the form, it will give you the guidelines under which you can take the deduction.
Okay, perfect. And did the guidelines on the form also address moves for, you know, for example, a military spouse who has to move because the service member moves?
I'm actually pulling up the form right now to look and see. Because here's the thing, if you're filing a joint tax return, and you're moving in order to be with your spouse because that's where their job moved them to, and that's what the military is their job, then my position on that would be, that yes, you moved because of a job.
Okay, so if the spouse
So they
is,
do have, okay.
yeah, so it sounds like, just make sure that I'm interpreting this correctly because we're getting some questions about it. If the service member is being moved, if they're getting PCS'd and the spouse is moving with them as well, it sounds like whatever costs they incur can be deducted even though it's not their job themselves, correct?
Right, because when you look at the moving expenses, it's related to both spouses on the tax form.
Okay, and is that the same regardless if you're filing jointly versus separately?
The separately, I'd have to look at it as far as whether or not it would be a available, because if you're filing separately, then the premise is that are you together? And if you're still living together but you file separately, I would say absolutely you could take the moving expenses.
Okay, sounds good. And we have just one more question about this topic before we move on. There was a question from one of our members who's on the line who mentioned that, they moved to another state. So the service member moved to the state where her ship is as a PCS, but the spouse, the non-service member, moved to another state so that she could be near her family, so during that time. And the Navy moved household goods. However, obviously they paid for both flights and personal vehicles. Would that be something that they could deduct for moving expenses? Or, considering the fact that the spouse actually didn't move to the PCS site, they moved back home to be with family?
I would need to look into that a little bit more because it's kind of a gray area. For me, I would need to look at how is it addressed in terms of the job is no longer where they're at, so there wasn't a need for them to stay living there, so they would need to move, and rather than moving to where the ship was located, they chose a second location.
Right, yeah.
So that would be something that I would need to research a little bit more.
Perfect. We'll get back to that.
Just the correct answer.
Sure. We'll get back to that member. Okay, go ahead. Thanks for letting me interrupt.
Oh, you're welcome. Okay, so I believe I covered all of the adjustments to the income here on the 1040. So again, there's an expanded tax and credit reporting section. This is where you have your standard deduction, and the standard deduction is listed on the left. So for single, it's $6,200. If you're married filing jointly, it's $12,400, and head of household is $9,100. So if your itemized deductions are less than this amount, you're better off taking the standard deduction. But if it's greater, then it benefits you to itemize the deductions. And you'll see where there's a foreign tax credit, which is linked to your investments. If you have investments in some of the mutual funds, they'll have stocks that are from a foreign country, and they take taxes out of it. You actually get credit for those taxes against the taxes that you pay on the income here. They have a residential energy credit here. It's a lifetime limit of $500 if you do anything to your home that improves the energy efficiency of it. And you'll notice under the other taxes that there's the self-employment tax, there's additional tax on IRAs or other retirement plans. If you take them out prior to turning 59 and a half, there's a 10% penalty. Line 61 is about the health care coverage, individual responsibility, and it lists two forms under, there's two forms off of the 8959 and the 8960, which is related to also the Affordable Care Act. It's on your net investment taxes side. So once you decide which form you're going to use and you're married, you can either file jointly or separately. So you cannot file an individual tax return if you are married. You can file a married filing separate tax return. It may result in higher taxes. It all depends on your individual scenario of how much each of the spouses earn. If you file a separate tax return, you're still required to list your spouse's name and social security number. There's a linking process that the federal government goes through. And you file federally married, but if you live in one of the states that doesn't recognize your marriage, you still have to comply with the state filing requirements, which may require you to file as two single individuals. So you may end up preparing 3 tax returns in order to get your tax returns prepared. There's both advantages and disadvantages, and I'm going to go over some scenarios in just a little bit. So you're filing your joint tax return. It doesn't matter which individual you put in as the taxpayer or as the spouse, but once you establish who's the taxpayer and who's the spouse, you really need to keep it in that order going forward. Legal names need to be used. They need to match what's on your Social Security card. The federal government ties tax returns to Social Security Administration reporting. So you want to make sure whatever your name is on your Social Security card, that's the name that you put into either the taxpayer or spouse if you're filing a married tax return. Filing status at the bottom shows, married filing jointly. So if you're filing your tax return as separately, you still list both of the spouses. You'll have the taxpayer and that Social Security number that's related to the taxpayer. The spouse's Social Security number will go into the spouse's Social Security number area, and the name will go down under the filing status, and you'll click married filing separately. One of the things that you need to remember if you're married filing separately is whatever one spouse does in terms of standard deduction or itemized deduction, the other spouse has to follow suit. So we'll get into the itemized deductions now. It's most commonly used when a home is owned.
Hey, Karen,
The common reason is that there's a high state income tax return. Yes.
Karen, I'm going to interrupt. I'm so sorry. So there's a quick question that I wanted to interject. You mentioned that it doesn't matter, and this is the same as last year. You've mentioned that it doesn't matter who is the taxpayer, right? And that versus, who's the second when you're filing the taxes. So, but that if you do list, spouse A as the taxpayer, that it should be kept that way. Now, when you say it should be kept that way, do you mean for both federal and state for 2014, or does that mean moving forward every year into the future that same person needs to be listed as the taxpayer?
From that point forward every year. And it should be the same, if you're able to file your tax return jointly at the state level, you want to make sure that you have it in the same order on both tax returns for the federal as well as the state. And you want to make sure going forward that you keep it in the same order as well, because of the way that they check your tax return and the documents that are received from other agencies. So like your W-2, if you have a 1099, if you have home mortgage interest, they link those to the tax return that you file. And so if you have the taxpayer one year as spouse A and the next year you have them as spouse B, you may create a blip in the system where you might get a notice from the IRS that says you underreported your income because A made more than B and B was listed first the second year. So you want to make sure that you're consistent once you establish who the taxpayer is going forward.
Perfect. Thank you.
Okay. So on the Schedule A, the deductions include the state income taxes, real estate taxes, as well as property taxes, your home mortgage interest, and the mortgage insurance premiums are still available for deduction on the 2014. They were scheduled to be removed from the schedule. The Affordable, Tax Increase Prevention Act, I believe is what it's called, that was signed on December 17th, made everything retroactive January 1st of 2014, so it's still available. Charitable contributions, both cash and goods. Casualty or theft losses, subject to limitations. It's basically if you lose anything that's over 10% of your adjusted gross income minus $100, you're able to take that deduction. The items that I talked about earlier were the unreimbursed employee expenses and tax return preparation fees. That's limited to 2% of your AGI. So here's the note: if you're married filing separately, if one spouse itemizes, the other spouse must itemize even if it's less than the standard deduction. So this is one of the things that you need to take into account if you're thinking, oh, maybe we should file married filing separately because it will benefit us. You know, make sure that you look at if one of you is going to itemize, the other one has to as well. So here's your Schedule A, and the sections are taxes, interest, gifts, casualty, and theft losses, and then the job expense and certain miscellaneous deductions. And that section here at the bottom, you'll see line 26 shows that it's multiplied by 2%. If it's less than the AGI by 2%, then you can't take any of the deductions. So medical and dental expenses, a little more difficult, and I didn't update the form, but it's the same in 2014. Just add a year to the form before, January of 1950. It's 10% of your adjusted gross income, so it's really difficult to get this deduction unless you've had a year where you've had high medical and dental expenses. If you're over 65, then that's where it drops down to the 7.5%. Other miscellaneous itemized deductions, if you're lucky enough to have some gambling winnings on page 1 of your tax return, you can actually put your gambling losses on the itemized deduction and reduce that amount that's being taxed. So as I said earlier, we would discuss in detail should you file separately or not. So the main question that I'm asked is, do I have to live with my spouse in order to file jointly? And the answer is no. You can file jointly whether you're separated by a deployment or by living in separate states. You're considered to be married regardless of your locations. Will we itemize our deductions? If you answer yes to this question, is it still advantageous to itemize a split with spouse on separate returns? That was the question that is probably going to be key if you're going to go separate. Is it going to benefit you to do so? Does one spouse make significantly more in earnings than the other? What tax bracket are the individual spouses going to be in? If you're both going to be in the 25%, filing separately may actually produce a higher tax liability. If you're in the highest of, tax brackets, also probably going to create a higher tax for you. If you're in the lower tax brackets, it could possibly be a wash. Each individual scenario needs to be looked at. Another thing that you need to be concerned with is, do you live in a community property state? If yes, then you're required to report 50% of each other's income.
Karen, I'm going to ask a couple of questions because there was one question. Yeah, there was a question from one of our members that said that they're relatively new legal residents of a community property state. So this particular couple happens to live in Washington State.
Okay.
And, they have proactively started to their return in TurboTax. Good for you guys to think ahead. But they're confused about how to allocate their income in terms of the community property. And so they just want to know what to do on the actual return itself.
Okay. So if they're married filing jointly, there's no allocation of the income for one or the other because 100% of the income will be on that tax return for federal tax purposes.
Okay.
If they're filing separately, then during the time that they lived in Washington State, for the federal tax return, they would report 50% of their own earnings and 50% of the spouse's earnings each, so that between the two tax returns, 100% of the income is reported. Now, their income prior to moving into Washington State, since they were not in a community property state, if they're filing separately, they would report only the income that they each individually earned.
Perfect. Thanks, Karen. It looks like that makes sense to the member who asked the question. Bradley, if there's additional questions, please feel free to email or continue to post. The other quick question I have is just because you touched on it, you mentioned, the difference in spouses' earnings. So are you saying that if there is a huge difference in spousal earnings, that you would suggest that in general filing separately is better?
No, it depends, because what happens is, as a single person making a larger amount of money, the married filing separately tax table will actually tax you at a higher rate. There's a lower threshold of what you can earn at each of the tax rates.
Perfect. So if there's a huge disparate, if there's a disparate income between the two spouses, it might actually be better to file jointly, because then it lowers that tax bracket.
Right. The threshold changes. So if you're filing married jointly, you stay in the 25% bracket, say up to, and I do have it in front of me, but I'll look it up in a minute. But say you stay in the 25% tax bracket up to $112,000. But if you're married filing jointly, in order to stay in the 25% tax bracket, you have to stay under $100,000. So there's a disadvantage in the tax table going separately versus jointly.
Got it. That makes sense. What if your spouse doesn't work at all? So what if the service member is the only one who has income? So the spouse has actually literally $0 for income. Should they still do a married filing jointly?
Absolutely.
Or, okay.
Yeah, I mean, it benefits because you get the lower tax brackets, but you also get the additional exemption on the.
Perfect.
So it's like you lower the income within the tax bracket as well. So give me a second here. I'm actually looking up the tax brackets for 2014. The 25% tax bracket, if you are married filing joint, the 25% tax bracket goes up to taxable income of $73,800. But if you're married filing separate, the tax bracket goes up to $36,900. So it's basically 50%.
Okay, perfect. Thank you.
Okay. Please note that if you have children and you have physically lived with your spouse for more than 6 months, you cannot file head of household. So head of household is available if you are a single parent of a dependent, a child that's under the age of 18. So here's some of the scenarios. I wanted to give you, what does it look like if you do a married filing separate scenario and a married filing joint. So with both spouses making around the same income with taking the standard deduction, you'll notice that whether they file joint or separate, the savings is minimal. It's $6. And it's because of the way that the tax bracket works out. Their taxable income is identical. Whether it's, $73,800 or $36,900, the tax will be the same. So then the next scenario that I wanted to take a look at is if one makes more than the other, taking the standard deduction again. You'll see that, spouse 1 makes 3 times what spouse 2 makes. Standard deduction, you have your exemptions. You get into your taxable income, and there's actually significant savings of $3,600. So if you take the one spouse making more than the other and you say you want to utilize itemized deductions, then you look at the wages, the deductions, the exemptions. The savings is not as great as the standard deduction, and you'll notice that on the itemized deductions they're $25,000, but they're not split 50-50. The assumption is that if you're taking itemized deductions based on your earnings, one of you, the one that's making a larger amount of money, will have been deemed to pay more of the deductions on the house, the real estate taxes, the mortgage interest that are related to it, as well as having higher state income taxes because their level of earning is higher. But there's still a savings. So that's a quick overview of how to file the tax return. Are there any questions that pertain to that before we move on to whether or not you should go into a prior year?
I have one question that came up, and I believe I know the answer to this, but I'm going to defer to our tax expert. So there's a question saying, if we use Smile, Amazon.com, so for example, AMPA actually has an account set up with Amazon such that a portion of that sales goes as a donation to our nonprofit. Of course, it's my understanding that you're not paying more for the item being purchased. It's actually just that Amazon is doing the donating. So the member is asking if we've used Amazon Smile to purchase items and have donated to charity, can we claim that? And my inclination is that the answer is no, because you are not actually donating money. That's what Amazon is doing, and the reason why they're probably doing that is so that they themselves as a company gets a tax deduction. But I just wanted to make sure that I'm understanding that right. Is that your understanding, Karen?
That is correct. Basically what they're doing is they're saying, we know you have the right to buy anywhere, but part of maybe what you're want to do is support an organization and you need an item. We'll be more than happy to take 5-10% of what you're buying from us and give it to that organization. But you're not physically taking your money and giving it directly to AMPA. So the thing to know about charitable contributions is, first and foremost, if you give any amounts that are in excess of $250, you have to have a letter and or a receipt from that organization that indicates that you gave to a nonprofit, that no goods or services were received, and the date of the contribution. You don't have to send that into the IRS, but you need to keep it in your records. In the unfortunate event, if you get audited and they want to see what your records pertaining to your charitable contributions are. The other area that you can, do charitable contributions is goods, household goods, clothing. When you give to the Goodwill, when you give to the Vietnam veterans, any of those organizations that take in those items, you want to make sure that you keep an extensive list of what you've given. In some cases, depending on what it is, you may want to take a picture of it to show that it's in good working order. And then if you go to, I believe it's Goodwill, I know Goodwill has this, they have a thrift shop value table that you can go and look and see, what's the value of a shirt, slacks and all of that, and use that for the basis for taking the non-cash item deduction for that good. Because that's another area that they kind of look at where, you say you gave 3 bags of clothes and you value it at $300. If you get audited, they're going to want to know what kind of clothes they were and whether or not it really was valued at the 300. So as far as charitable contributions go, you physically give the money or you physically give the goods. Or another way that you can give to a charity is if you purchase tickets to maybe the AMPA gala, but you don't use them and you give them to someone else to use. Because that's benefiting a nonprofit on the purchase of the tickets, it's actually a deduction for you on your tax return as a charitable contribution of non-cash variety. It would be donation of goods because the tickets are goods. So did that answer the question on the charitable contribution?
Yeah, thank you. And then before we move to amend or not amend, just in general, how long should you keep records of all receipts, including the tax forms? And just for the person who's asking the question, any receipts that you keep should really be kept, or any receipts for example, itemized deduction that you're keeping should be kept with your tax forms for that year. So you should have like one giant envelope for 2014 and one giant envelope for 2013 and all that, and keep all of those receipts with the corresponding year. And then how long, Karen, do you recommend saving those in the event that IRS, or how long does the IRS require that you save them in case they do audit you?
So generally speaking, there's 3 years of your tax returns that are considered to be what's called open, that the IRS can come in and audit and or request additional documentation. Sometimes it's not even a full audit. They'll just say, hey, we noticed that you're outside of the parameters for your charitable contributions based on your income. We would like to see copies of the letters you received from the charities. And so it's basically it's 3 years plus the current year, so that's 4 years. So what I generally recommend for individuals is that you keep at least 4 years of record, including the current year. So anywhere between 3 to 5 years of receipts should be on hand at any given point in time. As with the tax return, if it's been filed, you'll have 2014 with receipts, 2013 with receipts, 2011 or 2012 with receipts, and 2011 with receipts. So if you have a business, you need to keep your records for 7 years.
Okay, great. Thank you. And there actually is a question about, from a member who was married. I believe they were married in 2012, and they're wondering, are we required? It sounds like they really kind of don't want to go through the hassle of going and doing an amendment. But as it's a good segue to your next slide, they're asking, yes, are we required to do an amendment now that there's been some changes in some of the equality?
So first and foremost, prior to 2013, you are not required to go back and amend any tax returns that were filed as 2 individual single returns. The federal government started the requirement for filing a married tax return in 2013. For some people, it benefits them to go back and amend the tax return. For others, it does not. So if you're unclear as to whether or not you should amend or not, of course, the number one question was, were you married in those years? So, were you married in 2011 and 2012? And if we were to take our taxable income and combine it, if we were able to take itemized deductions as, one of you took the itemized deduction but the other one took standard deduction, how does that affect where the taxable income will be? For the California state tax returns, prior to 2013, they were actually required to do 2 individual federal and a joint state tax return if they were both married or in a registered domestic partnership. So that's a unique situation there. The way that I, looked at it for a number of clients is I prepared a draft tax return. Take a look and see. If you combine the income and you come to an amount that you're going to pay tax, absolutely do not amend. It's not required. If you do the draft tax return and it comes back that, hey, we're going to get a refund, depending on what the size of the refund is, I would say go ahead and amend the tax return. If it's minimal, the only caution that I give people is that if you amend the tax return, it leaves the statute of look back for the IRS open an extra year. Because now that you've created this amended tax return, instead of 2011 dropping off next year, it's actually going to stick around for 2 more years. If it's 2012, it'll be another year that you have that year open for the IRS to do an examination. So again, it's another, let me look at the scenario, how does it benefit and or does it benefit us to do the amended tax return? But you're not required to. So, as things get more complicated, should you prepare your own return? Which form are you going to be using? 1040EZ or 1040A, or the 1040 with the Schedule A? Have you prepared your own tax returns in the past? Other than maybe getting married this year, were there any other major tax changes or major, I'd say tax life, but major changes in your life that affect your tax? Did you purchase a home? Did you adopt and or have a child? The other reason why the majority of my clients come to me is they want representation if their return happens to be picked for an audit. If I have a client that gets a request for documentation and or they're scheduled for an audit with an IRS agent, they don't ever talk to that agent. I step in and I represent them in every aspect of that audit going forward. So the IRS has guidelines on their website, how to find and prepare. So here's healthcare coverage reporting. This is the new reporting requirement that was brought into place because of the Affordable Care Act. So the good news is that if you were in the military and or married to a military member for the entire year of 2014, all you need to do is answer that you had full year coverage, and that's it. You're done with that requirement. If you got married during 2014 and the non-military person had coverage prior to that through their work, then you can click that you had full year coverage. There's no additional information that needs to be reported on. It does include health care on yourself as well as any dependents, which include the spouse and any children that you may have. So if you were fortunate enough to go into the government marketplace and receive your health care coverage through there, and you had a subsidy, or they said here's your premium and you paid it and you paid 100% of it, you'll receive what's called a Form 1095A in the mail, and it gives you all of the information that you'll need in order to fill out the 8962. So the 8962 is a new form for 2014 if you had the marketplace granted coverage. You put in the, hold on, I got ahead of myself. I apologize. That's 8962. If you didn't have coverage in 2014 for all 12 months, you have to fill out the Form 8965. And there is, I believe what they're calling it is an excise tax that is due for any month that you didn't have insurance. So if you went to the marketplace and you were granted a coverage exemption because of a number of items, the 8965 is where you'll report that exemption certificate. And here's where it shows the name of the individual, your number, and the exemption certificate number. Go ahead.
Karen, I'm sorry. Yeah, I have a
Yes.
question. So, and I might
Yes.
be jumping the gun here. So if you're going to answer this later, feel free to defer. There's a question about, what if somebody is in between jobs? So say somebody worked, January through August and then left their job, for example, and this obviously would not be the service member, or maybe it's somebody who just recently joined the service last year, and then left their job, and so for like a period of, I don't know, 3 weeks maybe until they had their next job, they were then effectively uninsured because they didn't have employment-based health insurance. So what do people, how are they handling people who are doing job switches, knowing that most times somebody doesn't stop a job one day and the very next day start a new job?
So here's the interesting thing, and it's in the directions for the form. You're considered to have health care coverage for a month if you have it for 1 day. So depending on when the lapse occurred, if it was over the course of 2 months, so say you left the middle of August, so you're covered for August, you go to your new job in September, you start the last week in September, and you're eligible to get on the health plan that last week of September, you're considered to have insurance both in August and September, even though the entire month was not, you were not truly covered because you had that lapse.
So as long as you have insurance 1 day of a calendar month, you do not have to report that as a lapse in insurance.
Correct.
Okay, great.
It's kind of like, who's going to sell you a 1 day policy, but that's the way that the law was written. So there's a couple of exemptions that if you had household income that was behind or below the filing threshold, you're exempt from having to have the health insurance, or your gross income is a hardship. So if you fall into this category, my recommendation is, there's a publication, there's the instructions that come with it. I would probably read the instructions about 4 times before I started filling out this form. I know for us in our firm, we have a 4.5-page questionnaire just on this form of all the questions that we need to ask. So don't feel like you're losing it if you look at it and just have no idea how you're supposed to fill out the form. So I have not had a chance to go into TurboTax this year to find out how they're addressing this in their questions. So if you're preparing your own tax return and you're using one of the tax softwares, I would recommend that you read the instructions for this form, as well as using the tax return software. So this is the form that I thought I was going to be doing first. If you did go into the marketplace, the government marketplace, and you did receive your coverage through the marketplace, you could have received what they called a subsidy at the time, where instead of paying the full premium, you paid a portion of it. The marketplace application granted you assistance to help pay or help defer the full amount. You have to report, this is where the 1095A form will come into play, and you will put the information on this form. it's a little more extensive. They want to see if you're eligible for, I think line 4 is federal poverty line. If you fall below the federal poverty line, you actually should be eligible for your state Medicaid. So you know, would be on that health insurance plan without having to pay anything out of pocket. So if you did receive the subsidy, this is the part 2 is where you actually have to reconcile against what you received and what you should have received based on your true numbers, because when you do the application in the marketplace, it's based on estimates. So this section will actually reconcile against what you did get and what you should have gotten, as well as giving you credit if you should have gotten it, what that should be. So another form that I highly recommend, that if you choose to do your own tax return and you fall into this category, that you read the instructions for Form 8962. Again, I don't know how TurboTax is handling it. I would imagine that there's a series of questions where you're going to go through and put in all of the information in the program. So I think the IRS has actually started to accept electronic filing of the tax returns. So we're in tax filing season. If you're able to utilize the free filing through the IRS for the federal tax return, you know, if your return's simple enough and you are underneath the threshold, I would recommend that you use it. If you're not comfortable with preparing your own tax return, I would recommend that you find a preparer with knowledge of your specific issues, whether it's, you know, LGBT, if it's LGBT with the military, all of the issues that are personal to you. You want to make sure that you find someone that you feel safe going into and that you trust to do your tax return. So the IRS lists the different types of preparers. Generally speaking, the IRS will only allow 3 types of preparers and or professionals to represent you, and that would be a CPA, an enrolled agent, and an enrolled agent is someone that takes a test through the IRS to prepare tax returns, and an attorney. Look in a local business, call your local community center, your LGBT community center, or find out from your friends who are they using. Unfortunately, this happens sometimes. If you believe that you were given incorrect or fraudulent advice, you can report that individual. All right, questions about federal tax filing?
Thank you so much, Karen. Can you bring up your last slide just so it's on the screen for folks to look at? It was a really great summary slide about tips too. There you go. Just so people have it to review. I kind of want to just pipe in and reiterate to what Karen had said. I want to let all of our members know that if at any point during the filing process that you are sitting with somebody who's preparing your tax return and you feel uncomfortable, maybe the first day you felt fine, but the second day you're following up with them and you starting to feel uncomfortable in any way, shape, or form, that, you know, this is somebody that you are paying to provide a service. So as with anything, you know, if you're at a restaurant and you feel uncomfortable, or if you're, you know, paying any sort of vendor for any service and you're feeling uncomfortable, it is well within your rights to leave. So I want to make sure that you know that if you're getting the sense that either the person is not, had maybe originally said that they are familiar with LGBT filing process and or the military process, and then you kind of get a feeling that maybe they might not be as well versed in those topics as they had said, or if you feel uncomfortable at the way that they are handling, maybe their own personal comfort level with your guys' filing process, you should feel very empowered to decide not to move forward, even after even if you have started to give them some of your financial information, there is still time for you to choose someone else to prepare your tax returns. I also want to make sure that you all know there are free services available for service members. So Military OneSource, so the word military and then the word one, O-N-E, source, S-O-U-R-C-E. If you were to Google that or go to militaryonesource.com, they do provide free filing for service members. Now, I know that there were a few AMPA members that used their services last year. Whether or not their volunteers are well versed in LGBT military remains to be seen this year, so everyone's getting new training. So I would just let you know that, federal taxes are quite a little bit more simple for those volunteer services to provide for our families. But when it gets to the state level, for those of you who join us next weekend, when we talk about state taxes, they may or may not be as well versed. So it is possible that you could go and use a free service, for example, for filing your federal taxes, but particularly if you live in a non-equality state, you may want to do those ones yourselves or have somebody have a tax preparation for your state taxes. But I definitely want to make sure that you all know that there are free services out there, and Military OneSource is a reputable source that that you can go to as well. And to reiterate Karen's point, if you go to, even if you never go to your local LGBT center within the area that you live in or the county, most places do. I know some of our members are really out in the cuts in rural areas, but if you do live near a LGBT center, they are a phenomenal resource for not only tax preparers, but for example, for those of you who are looking for LGBT-friendly health providers, and all sorts of other resources. So if you are new to an area, say maybe you just PCS and you don't have somebody and you're not sure who's around you locally that that would be able to assist you, that's a really good resource, and they can at least point you in the right direction. So that being said, I wanted to make sure to open up the floor to questions. We've been able to answer, I believe, correct me if I'm wrong, all of the questions that have been posted in the chat or question section. But there is one question that is coming from a member who is not legally married. They live currently in the state of Kentucky, so they're not legally married, obviously, because they're not in an equality state. However, it's quote-unquote recognized. So I'm not quite sure what that means. I'm not familiar necessarily with what recognized would mean in Kentucky. And the member says that they've been together for 2 years, and she has been the primary source of income. So she's kind of wondering, how to handle their taxes, because I guess her spouse is still on her parents' insurance but is about to age out. She happens to be medically retired from the service, so she's the vet, and was only able to work for a month at UPS, but has her GI Bill. So I'm not sure, Karen, if this is something that you're able to address now, or if it would be better to talk one-on-one with this individual, because I'm not sure how if you're not legally married, how that would all work out.
Right. So first and foremost, for federal filing, you have to have been legally married in one of the states where it's recognized and or one of the countries. Otherwise, you're a single individual. What could possibly happen is if you're two individuals living in the same household, one of you is working and or supporting the other one is not a dependent of any other person and is making less than the filing threshold, you can actually claim them as a dependent on your tax return as a single tax filer. And I can get into those particulars with anyone that fits that, but that is a scenario that is available.
Okay, so Caroline, it looks like it would be a good, or for any of our members who are in this situation, it looks like it would be a good idea to kind of talk more one-on-one to see if they do qualify as being able to list you know, their partner, meaning they're not legally married, but to list their partner as a dependent, and they may actually qualify for that based on, you know, some specifics. So I'll make sure that we touch base offline with this member. So if you are in that situation, please just make sure to send me an email. Karen, do you happen to have a slide that has your contact?
It's actually at the end. Let me get to it.
Oh, sorry. Go ahead.
That's okay. So, of course, the state tax return questions we'll address next Sunday before the Super Bowl. And here's my contact information. Real quick, because I know that it came up on the AMPA Facebook site. Someone was asking about if they're a non-resident, if they're a resident of a foreign country, but they're living here with their U.S. resident. I wanted to point out real quick that there's a publication called 519, U.S. Tax Guide for Aliens, and an individual who is not a resident of the United States but is living here is considered to be a resident alien, and there's ways that they can file a joint tax return with their U.S. resident. So I wanted to point that out, that there are guidelines for addressing that issue on the IRS website. It's publication 519. And I'm also available if I don't know if they're in the seminar or if they'll be listening to it later, but I am available via email to answer any specific questions on that.
Perfect. We have a question that came in, and it's a great question because I know this is applicable for many of our spouses. So it's from a spouse who happened to work on Guam for a couple of months before moving with his husband to Florida. So they currently live in Florida. But this member is asking, how do I file this, or how do I account for this income, you know, since it's an out-of-area W-2. Now, I'm not sure if this really applies, if there's a difference in how it's going to be recorded on their federal versus state. And I know we'll talk about the Florida state taxes next week. But in terms of the federal filing for somebody who, you know, made some money in Guam for a couple of months of the year, what would they do?
So if they're a U.S. citizen, the filing requirement for the Form 1040 is that you report all of your income, and I believe the word that they use is worldwide income. So if they are a U.S. citizen, the W-2 from Guam would be reported on the tax return. And there's, I'm trying to think, I'll have to research it a little bit, but there is a provision by which they get credit for the taxes that they paid on the income to Guam against their federal income taxes that they would pay against that income as well here. So if we can get their contact information, or if they will email me, I will be able to give them more specific guidelines as to how to include the Guam income in there.
Perfect. Let's see. And I think that's it. So before we end, or while we're still letting some more people file in any questions, any last minute questions, please, if you were to, I'm sorry I don't have my contact information on the slide as well. Of course, you can find me on Facebook. You can also find me on militarypartners.org under the leadership section. Again, my name is Lori Hensick, and I am the director of research. I'm the director of policy and research for the American Military Partner Association. My email is very easy. It's Lori, so Lori, at militarypartners.org. So if you do reach out to Karen or myself, please feel free to CC both of us in your email communication, just so we can make sure that we're keeping track of all of the questions, so that not only are we making sure that we answer you, but these questions are really phenomenal, because whatever questions you have, I'm sure some of our other members who were maybe unable due to scheduling conflicts, unable to join us on the webinar, they could benefit from as well. So we do like to keep track of these questions so that we can kind of share them as FAQs. Of course, we'd remove any personal information, but we'd like to kind of use it for the benefit of all of our members who probably have the same questions. So great questions for you all. And remember, just take down Karen's email and my email. Karen, we've got some people asking you straight out if you are willing to accept some AMPA members as clients, even if they don't live in Michigan. So
absolutely. And real quick, for the individual that asked about Guam, the form 5074 is the form that needs to be prepared with reference to the federal tax return to show the income related to your time in Guam. So in answer to requests as to whether or not I will take on new clients, the answer is yes. One of the things that I will share with you is that if I do a tax return for AMPA, I will, much the same way as Amazon, I will be taking a portion of what you pay me and I will be giving it back to AMPA.
Thank you, Karen. We really appreciate that. We appreciate all of the donations from all of our members. You know, it's as you all know, that our organization at AMPA, we are 100% volunteer run. Many of us have full-time jobs, be it full-time jobs with children at home or full-time jobs working as working stiffs. And in addition to that, we do our work, all of our advocacy work for AMPA on the side on nights and weekends. So the benefit of that is that any donations that are made to AMPA go 100% back to our members. So for those of you who were able to donate money to AMPA within 2014, just know that in itself, we are a registered nonprofit, and so we are recognized by the IRS as one that which you could use, you could deduct your donation from your taxes. So that's another benefit. So if you're moving forward in 2015, if you're looking for a way to make a charitable contribution to lower your tax bracket, just know that any donation made to AMPA is a deduction that can be made on next year's tax return. So with that, I'm going to close out, and just to be sensitive to time, I'm going to close out the webinar. Many, many thanks to Karen. Karen, your kindness and generosity, it's always amazing. I'm personally touched by it, and I know that our AMPA leadership team is very thankful for you. Thank you all again for joining us on the webinar. Thanks for your interaction and your questions. And again, please don't be bashful. As we move forward into the heat of tax season, please make sure that you continue to reach out to us. The webinar will be recorded. It will be posted online if you want to go back for additional review. And make sure to let some of your other AMPA friends know that it will be online in the next 48 hours so that they can benefit from it as well. I do want to list one last caveat that Karen is a CPA. She is a partner in her firm, which means that I would assume that she's going to be very, very busy come the dates nearing April 15th. So it's likely that you will get a better response time and more comprehensive answers to your questions should they be emailed to us sooner rather than later in the tax season. So just in honor of her personal schedule and her work schedule, we'd like to try to make sure that she gets these questions as early as possible. So thank you again, Karen.
Thank you, Lori, and you're welcome. I always look ways to give back to those, you know, that have served. So, and being married to a vet, see it firsthand every day. So.
All right, everybody, have a fantastic weekend, and don't forget our next webinar, which is going to cover state taxes. And just so you know, regardless of what state you live in, we will be touching on the specifics for your state filing. So whether or not you live in an equality state or not, you will definitely get some beneficial information from our webinar, which will be on Super Bowl Sunday, scheduled a couple of hours before Super Bowl. So make sure that you register for it through the link as well, and we will talk to you then. Okay, thanks everybody. Have a great weekend.